The yield curve for the U.S. Treasury bond market just reached the biggest yield curve inversion since the year 2000, after the recent CPI data showed the highest inflation in 40 years. This is super important because inverted yield curves have historically been leading predictors for coming economic recessions and have accurately predicted the last 6 U.S. recessions. To explain why it's such an accurate predictor, let's talk about what the Treasury yield curve is, how it works, and what it's showing now. The first thing to understand is what a Treasury yield is. In simple terms, it's the annual interest rate an investor will get for owning the Treasury. This annual return is measured as a percentage return, which we call the Treasury yield. So if you buy a $1,000 10-year Treasury note with a 3% yield at the time, you are getting 3% interest each year over those 10 years for owning the Treasury, and then are repaid the original principal that you lent of $1,000 at the end of the holding period. Treasury bonds can be sold to other investors at any time, though, on the open market. So the current yield the Treasury offers reprices dynamically and can change based on what other investors are willing to pay for the bond in the market. Take this example from Investopedia. If a $1,000 bond with a coupon rate of 7% a year on the initial principal is later sold to someone else for $900, the investor that paid $900 is actually getting a yield of 7.8% since they paid less for the bond when they bought it. The important takeaway is that current yields on Treasury bonds are constantly changing based on what the market price investors are paying for that bond is. Its yield and the price paid for the bond have an inverse correlation. As the price paid for the bond increases, the current yield decreases and vice versa. This is the principle behind the yield curve. The yield curve looks at the different yields the market has currently priced in for U.S. Treasuries with different maturity dates, like 1-year Treasury notes, 10-year Treasury notes, etc. Typically, longer duration Treasuries like the 10-year Treasury note offer higher yields or interest than shorter duration Treasuries like a 1-year Treasury note. This is because holders of long-term debt are taking on more risk in theory because there's more duration on the bond, which makes it more exposed to interest rate changes, which could lower the bond's value if the interest rates change in the wrong direction. If interest rates rise, the market price of the longer duration bond will decrease more than the shorter duration bond. So with the increased duration risk, investors generally are not willing to pay for higher duration bonds over a shorter term Treasury unless there is a higher yield to help offset that increased risk that they are taking on. This causes a normal yield curve to slope upward, with yields increasing as Treasury maturity time increases. Like this chart taken from January of 2021, for example. We can see that as maturity increases on the x-axis, the yield also increases on the y-axis. However, the yield curve can in rare cases also do what's called a yield curve inversion. This is when shorter-term Treasuries start to offer a higher yield than longer-term Treasuries, because the market price investors are willing to pay for long-term Treasuries is increasing, which is pushing the yields lower than short-term Treasuries. Take a look at this chart, for example, from the close of the market on July 15th, 2022. We can see that the 1-year, 2-year, and 3-year Treasury notes are offering nearly identical yields and not increasing. And then the yields on the 5-year, 7-year, and 10-year Treasuries are actually offering yields progressively lower than the last. This is an inversion in the yield curve. Whenever shorter-term Treasuries start to offer higher yields than the longer-term Treasuries. You might be wondering why an inverted yield curve would happen in the first place if longer-term Treasuries are supposed to have higher yields to offset the increased risk they have on longer duration exposure to interest rate changes. An inversion reflects the fact that bond investors expect that we may be near a recession period in the economic cycle, and that in the long term, interest rates will probably decrease to offset that economic recession. The Federal Reserve Bank of Chicago published a letter analyzing yield curve inversions in 2018, and they said in the letter, quote, "The interest rate on a long-term bond in part reflects the path of short-term interest rates expected over the life of the bond. In turn, this expected path is influenced by views about the business cycle and monetary policy. If market participants expect a downturn, they likely also anticipate the Federal Open Market Committee will cut the future policy rate to provide monetary policy accommodation. The expectation of lower future rates reduces longer-term rates, and this could result in an inverted yield curve." End quote. Recall that the current yield and market price of treasuries are inversely correlated. So if the bond market expects long-term interest rates to be lowered and current yields to decline in the future, it means that they are also expecting the market price for the longer-term bonds to increase in the future, which means that they can be sold in the secondary market at a higher price than what they originally paid for in the bond. So belief that an economic downturn may be coming makes long-term bonds more attractive. Investors become more willing to invest in long-term treasury bonds since they provide safety as an investment from falling stock markets. They preserve the capital originally invested since the U.S. government will pay back the principal originally invested in the bond at maturity, and the bond also has the potential to appreciate in value and be sold later at a higher price than the investor paid for it if interest rates decrease, which would tend to push the price of the bond up. Since the Federal Reserve tends to lower target interest rates when there's an economic downturn in order to stimulate the economy, this means the market price of the bonds will likely increase as the yields fall, and the investor's initial investment in the bond can appreciate. As the investors buy long-term treasury bonds as a safe haven investment, the increased demand drives the market price of these long-term bonds up and pushes the current yield on them down, which can lead to an inverted curve where longer-term bonds have lower yields compared to their shorter-term treasury counterparts. The data for an inverted yield curve is a shockingly accurate leading indicator of a coming recession as well, with it correctly predicting the last 6 U.S. recessions. If you look at this chart from the St. Louis Federal Reserve website, you can see a history of the differences between the 10-year Treasury yield and 2-year Treasury yield. Note that the shaded parts of this graph indicate periods of U.S. recessions. As you can see on the chart, when the yield curve is normal and 10-year Treasury yields are higher than 2-year Treasury yields, the difference is positive and the line is above the zero mark. When the yield curve inverts and 10-year Treasury yields are lower than the short-term Treasury yields of the 2-year, the difference becomes negative and the line falls below the zero mark on the chart. As you can see, every time there has been a recession since the 1970s, the yield curve has inverted before the recession and fallen below the zero mark on this chart. Shortly after the inverted yield curve happens, there is a recession marked by the shaded areas in the St. Louis Fed chart. The inverted yield curve doesn't tell you the exact timing of when the incoming recession will happen, but a recession seems to occur 2 years or sooner after an inverted yield curve pops up on the chart in most cases. What's important to note on this chart is that in 2022, we now have an inverted yield curve between the 10-year and 2-year treasuries that first flashed in the beginning of April temporarily, before turning positive again. But now it's inverted and has been for most of July so far, which is not a good sign for the economy and reflects that bond investors may be preparing for a possible economic recession, within the next year or two. This coincides with record low consumer confidence data and growing expectations among business executives that we may be heading into a U.S. recession. So the bond market is not alone in this expectation either. It's important to note that historically, while yield curve inversions have been a strikingly accurate predictor of recessions, they are not the cause of recessions themselves and are just strongly correlated to them. They reflect bond investors' expectations that a possible economic recession is coming, which is why the expectations get priced into the bond market in the form of higher prices being paid for longer-term Treasury bonds and the lower yields that investors are willing to accept on those bonds compared to short-term Treasuries. Part of the reason the bond market tends to be an accurate predictor is that most bond investors are the quote-unquote smart money. Most bond investors are large banks and institutions which tend to have a more accurate understanding and prediction of where we are in the current economic cycle and what's coming next. So the bond market tends to create reliable signals of an oncoming recession when those investors begin to price it into the bond market. With that being said, it's always possible that the bond market could be wrong this time, even though they've accurately predicted every recession since the 1970s. Let me know what your thoughts are in the comments below, and if you think the inverted yield curve in the bond market is right about the US economy heading into a recession. If this video was helpful, be sure to subscribe to the channel for more finance content and news, and leave a like on the video. Thanks.